Interest rates in Canada have dominated headlines in 2025. The Bank of Canada has already taken bold action, slashing its key rate by more than 200 basis points in 2024. Since March, the rate has held steady at 2.75%. Markets are now anticipating at least 2 more cuts this year, which could bring rates down to 2.25% or even 2% by year-end. For many borrowers, these lower rates sound like a welcome relief. Cheaper mortgages, reduced loan payments, and improved cash flow. But here's the catch. Just because rates are falling does not mean the economy is out of the woods. While inflation has cooled from the highs of 2022, core inflation remains stubbornly sticky. Rising oil prices, ongoing supply chain risks, and persistent housing demand could all push the cost of living higher again. This is where the Bank of Canada faces a tricky balancing act. On one side, unemployment is rising, households are feeling the pinch, and businesses are desperate for cheaper credit. On the other, cutting rates too quickly could reignite inflation, undoing the hard-won progress of the past 2 years. As one economist put it, we might be underestimating how resilient inflation can be. The central bank must tread carefully to avoid triggering another inflationary surge. So, what does all this mean for homeowners and buyers? In the short term, borrowing will get cheaper, offering some relief. However, do not expect a return to rock-bottom rates. It is wise to budget with a buffer and assume rates could remain in the 2 to 3% range for some time. Protect yourself from surprises by planning for potential fluctuations in borrowing costs. Ultimately, 2025 is shaping up to be a pivotal year. The Bank of Canada must prove it can tame inflation without stalling economic growth. For Canadians, the outcome will be felt directly in mortgages, rents, and grocery bills. Stay cautious, stay informed, and remember, cheap money does not last forever.